Welcome to the Deep Dive. We're here to cut through the noise and get you the essentials.
That's right.
And today, well, we're diving into something that comes up a lot in finance talks right now.
The big one, crypto versus stocks.
Exactly. And for you listening, the real question is, is Bitcoin changing everything? Or is sticking with a solid stock portfolio still the best bet for your money?
Mm-hmm.
And this isn't just theory, right? Markets are always changing. New people are getting into investing. So understanding these two powerhouses, it's more crucial than ever.
It really is.
So our mission here really is to give you the tools, the insights to think critically about this stuff, help you make smarter financial moves that actually fit your goals.
And we've got a clear path laid out. We'll start with the basics. What are these things fundamentally?
Right, the core differences.
Then we'll weigh the risks and rewards side by side, get into what each one really offers and demands from you as an investor.
Mm-hmm.
And finally, we'll boil it all down to practical advice, helping you figure out what makes sense for your own strategy.
Yeah, whether you've been investing for years or you're just starting out, we want this to be clear, maybe offer some surprising facts, but definitely not overwhelm you.
Exactly. No excessive jargon, just clarity.
All right, let's jump in then. To really get where this whole debate is going, we need to understand the basics first. These are like two totally different animals, investment-wise.
Completely different beasts, yeah. Each with its own history, its own mechanics.
So where should we start? Stocks, maybe? The old guard?
Let's do it. Stocks. The titans of finance, you could say. So when you buy a stock, you're actually buying a tiny piece of a company.
Like a literal fraction of ownership in, say, Tesla or Walmart.
Exactly. Any public company and its value. Well, that hinges on how the company's doing, what the overall market looks like, and, how investors are feeling about it.
And stocks have been around forever, basically. Not some new fad.
Oh, centuries. Think back to the Amsterdam Stock Exchange way back in the 1600s. That was one of the first organized places for trading.
Wow. And then in the U.S., the New York Stock Exchange, founded 1817. A cornerstone, really.
Absolutely. But what's really key, looking at the long haul, is the S&P 500.
Ah, the benchmark.
Right. Historically, it's given average annual returns around, say, 7 to 10%. And that's after inflation. We're talking data from 1928 all the way to 2024.
Nearly a century. That
Wow.
consistency. That's the power of compounding, right? It shows how even smaller amounts can build real wealth over time.
Yeah.
That's the insight for long-term building.
It really is. And practically speaking, how do you invest? Through a brokerage account.
Yep.
You buy shares, your money grows if the share price goes up, or you might get dividends.
Right, a slice of the profits.
Exactly. And a big factor here is regulation. You've got bodies like the SEC making companies report their financials.
Adds a layer of transparency, accountability.
It does. Now, it's not foolproof. We've seen fraud cases like Enron, but it's a crucial safeguard compared to, well, other areas.
Okay, so stocks are about betting on businesses, their growth, their profits, all within this established, regulated system.
Pretty much.
Now, how does that stack up against crypto? Because crypto feels different. It's tied more to tech, to big ideas, not necessarily companies in the traditional sense.
Totally different world. Cryptocurrencies are digital assets. They're built on blockchain technology.
Okay, explain blockchain simply.
Think of it like a shared, secure, unchangeable digital spreadsheet or ledger. It records every transaction across a huge network of computers. No single person controls it.
Decentralized, so that's the key word.
That's the key. Bitcoin and Ethereum are the big names you hear, but there are thousands out there.
And you buy and sell them on exchanges like Coinbase or Binance.
Right? Or through digital wallets.
And the history here is much shorter, but just as dramatic, maybe more so.
Definitely more dramatic in a shorter time. Bitcoin started it all in 2009. Created by the mysterious Satoshi Nakamoto.
Still anonymous, right?
Yeah. Still anonymous. The idea was a peer-to-peer digital cash, no banks, no governments involved.
And then came Ethereum.
Yep, 2015. Ethereum was a game changer because it introduced smart contracts.
Okay, what are those exactly?
They're like little programs or automated agreements that run on the blockchain. They execute automatically when certain conditions are met. No need for a middleman.
So that opened up new possibilities.
Huge possibilities. Things like DeFi, decentralized finance, trying to rebuild finance without banks, lending, borrowing, all on the blockchain.
And NFTs too, right? The digital collectible.
Exactly. Non-fungible tokens, proving ownership of unique digital items. That all runs on blockchain tech, mostly Ethereum initially.
And the market just exploded at one point.
It hit a peak market cap of around $3 trillion in 2021. Massive. but it's definitely known for its wild price swings since then, too.
Volatility is an understatement sometimes.
For sure. And how it works is different, too. You buy on exchanges, store in wallets, and it operates 24/7 globally, nonstop.
Unlike stock markets with their opening and closing bells.
Right. And this always-on nature, plus the fact that it's generally less regulated than stocks, well, some see that as a huge plus. Financial freedom.
But also maybe a risk.
Also a definite risk. That lack of regulation cuts both ways. Investors really need to understand that part.
Okay, so we've got the basics down. Stocks, established businesses, regulation, long history, crypto, new tech, decentralization, high speed, less regulation.
That's a good summary.
Now let's get into the core of it for investors, the balancing act. Potential gains versus the risks involved.
Right. Every investment has both. Let's unpack that for each of these.
Where do we start? The case for stocks.
Let's make the case for stocks first. The biggest pro. Stability and that long-term track record we mentioned.
That's 7–10% average from the S&P 500.
Exactly. Especially if you reinvest dividends. And think about solid blue-chip companies like Microsoft. They've been reliable growers for a long time.
And diversification is easier with stocks.
Much easier. You can spread your money across different sectors, tech, healthcare, energy, whatever. Or just buy an index fund that holds hundreds or thousands of stocks. That really lowers your risk from any one company failing.
Reduces the eggs in one basket problem.
Precisely. Then there's the regulation we talked about. Public companies have to disclose their financials. It helps, even if it doesn't stop everything bad.
Like the Enron example.
Right. And finally, dividends. For many people, getting that regular income stream is a big plus. Passive income.
Okay, so stability, track record, diversification, regulation, potential income. That sounds pretty solid. But obviously, stocks aren't risk-free. What are the downsides investors need to watch out for?
Absolutely not risk-free. The big one is market risk. Stocks can crash.
Like 2008, or the COVID dip in 2020.
Exactly. Even a diversified portfolio could suddenly drop 20%, 30%, even 50% in a severe downturn. It happens.
So you need a longer time horizon.
Definitely. Stocks are generally best if you can leave your money invested for the long term, say 5+ years, ideally decades. Trying to time the market or trade short term, very risky, often leads to losses after taxes and fees.
And they're sensitive to the economy.
Highly sensitive. Recessions, rising inflation, interest rate hikes, all that stuff can really hit stock prices hard.
So stocks are the tried and true, maybe more predictable path, but definitely not foolproof.
Well put. Not foolproof at all.
Okay, let's pivot to crypto then. If stocks are a steady climb with occasional cliffs, crypto often feels more like a rocket ship that might explode.
That's not a bad analogy. The biggest pro for crypto is absolutely that potential for massive returns.
The stories are legendary.
They are. Bitcoin going from basically nothing to $69,000 in 2021. Early Ethereum investors seeing incredible gains. It's the definition of high risk, high reward.
What else draws people in?
Decentralization is huge. The idea of money or assets outside the control of governments and banks, that really resonates with people. Especially, say, in countries with unstable economies or high inflation.
A different kind of safety, perhaps.
For some, yes. And then there's the innovation angle. Blockchain tech is genuinely new and potentially transformative. NFTs, DeFi, Web3. This could reshape finance and other industries.
The potential is there.
It is. And lastly, accessibility. It's often easier to get started with crypto. Lower barriers to entry, you just need an internet connection usually.
Okay, high potential returns, decentralization, innovation, accessibility. Sounds exciting. But the flip side must be just as extreme. What are the big cons?
Oh, they are significant. Number one, volatility with a capital V.
We touched on that. Massive swings.
Massive, rapid swings. Bitcoin dropped something like 70% from its 2021 peak by mid-2022. Many smaller coins, altcoins, can lose 90% or more of their value very, very quickly.
Ouch. That's stomach turning.
It is. Then there's regulation risk. Governments are still figuring out how to handle crypto.
Crackdowns are possible.
Definitely. China banned crypto trading entirely in 2021. The U.S. and other countries are tightening rules. New regulations could absolutely impact the market, maybe limit growth or certain uses.
Security is another big one, right? Hacks, scams.
Huge. Billions of dollars have been lost. Hacks of exchanges, sophisticated scams, people losing their private keys and having no way to recover their crypto.
The Mt. Gox hack back in 2014 was a classic, terrible example.
A landmark disaster. They lost 850,000 bitcoins. gone forever. That risk is always there.
And finally, speculation. Sometimes it feels like prices are just driven by hype.
A lot of it is, especially with newer or smaller coins. Remember the meme coin craze in 2021?
Dogecoin to the moon.
Exactly. People piling in based on tweets or online buzz, not on any real value or utility. That kind of hype drives bubbles that inevitably pop. So much of the market can be pure speculation.
Wow. Okay. So crypto, potentially life-changing gains, but also potentially devastating losses, regulatory uncertainty, security nightmares, and a whole lot of hype.
That sums it up pretty well. It's a high-stakes game.
So for you listening, after hearing all that, the million-dollar question, or maybe the Bitcoin question, how do you choose? Which path is right for your financial journey?
And that is the absolute key takeaway. There isn't a single better choice here. It's not stocks or crypto is best for everyone.
It depends.
It totally depends on your personal goals, your tolerance for risk, the strategy that fits your life and your finances.
Okay, let's break that down. What are the key factors you should consider?
All right, factor number 1, risk tolerance. Really be honest with yourself here.
How much sleep can you lose?
Basically, yeah. Stocks, especially diversified ones like index funds, are generally for more conservative investors or anyone with a long time frame. 5 years plus minimum gives you time to recover from dips.
In crypto.
Crypto is for the high-risk end of the spectrum, someone who is genuinely okay with watching their investment value swing wildly. And the golden rule applies more than ever. Only invest money you can truly afford to lose entirely.
Because it might actually go to zero.
It absolutely might, especially with smaller coins.
Okay, risk tolerance first. What's next?
Time horizon. How long are you planning to invest for?
Stocks seem built for the long haul, like retirement savings.
Exactly. Perfect for things like a 401k or an IRA where you have decades for growth and compounding, and market dips become less scary over time.
And crypto for the long term, what does that look like?
Well, people do it. They call it ho-dealing, holding on for dear life.
Right, the famous typo.
Yeah. It means riding out the massive waves up and down. But doing that requires a really strong belief in the long-term future of blockchain technology itself. It's less about short-term gains and more about faith in the tech's ultimate adoption.
Okay. Risk tolerance, time horizon. What else?
Knowledge and research. You can't just jump in blind.
What kind of research for stocks?
For stocks, you need to understand the companies. Look at their financials, revenues, profits, debt. Understand metrics like the PE ratio, price to earnings. Is the stock expensive or cheap relative to its profits? Look to industry trends. Resources like Morningstar or Yahoo Finance are good places to start.
And for crypto research, it seems different.
It is different. You need to understand the technology. What makes Bitcoin secure? How do Ethereum's smart contracts work? What problem does this specific coin solve? And you have to be super wary of hype, especially fancy white papers for new, unproven coins. Dig deeper than the marketing.
Healthy skepticism required.
Extremely healthy skepticism. And finally, diversification again.
How does that apply differently?
Well, with stocks, as we said, you can spread your risk across many sectors, many companies, or use index funds. Very broad diversification is possible.
Okay.
With crypto, diversification is trickier. If you do invest, most experts would suggest sticking mainly to the established players.
Like Bitcoin and Ethereum.
Exactly. They make up something like 80% of the total crypto market value. Putting everything into tiny speculative altcoins is adding a huge amount of extra risk on top of already risky assets.
Got it. So it sounds like for many people, it might not be an either choice, but maybe finding a balance.
That's often a sensible approach, yes, especially for younger investors who have a longer time horizon.
What might that look like practically?
A common strategy you hear about is maybe putting the large majority of your portfolio, say 90%, into diversified stocks like a broad S&P 500 ETF. Low cost captures the market.
The stable core.
Right. And then maybe allocating a small speculative portion, say 10% or even less, to the major cryptocurrencies like Bitcoin or Ethereum, something you can afford to lose but gives you exposure to that potential upside.
A small bet on innovation, maybe.
Kind of, yeah. A calculated risk within a mostly stable portfolio.
Okay, that makes sense. Now, if someone's listening and thinking, all right, I want to dip my toe in, what are some practical first steps?
Good question. First tip, start small, really small.
Don't bet the farm.
Please don't. Test the waters. Put $100 into a stock ETF or maybe just $50 into Bitcoin. See how it feels, learn the process without risking much.
Use reputable platforms.
Absolutely crucial. For stocks, use well-known brokerages. Vanguard, Fidelity, Charles Schwab, even Robinhood, but understand their fees and how they work.
And for crypto?
Go with major trusted exchanges like Coinbase, Kraken, or Binance, depending on your location and needs. And importantly, learn about secure wallets. Don't just leave large amounts sitting on an exchange long term if you can help it. Not your keys, not your coins, is the saying.
Good advice. What about managing the ups and downs?
Dollar cost averaging is your friend here, especially in volatile markets like crypto.
Explain that quickly.
It just means investing a fixed amount of money on a regular schedule, say $50 every month, no matter what the price is. When prices are low, you buy more shares or coins. When they're high, you buy fewer. It averages out your purchase price over time and removes the temptation to try and time the market perfectly.
Takes emotion out of it.
Mostly, yeah. And stay informed. Follow reliable news sources. CoinDesk is good for crypto news, Bloomberg or the Wall Street Journal for broader market news.
But don't just chase headlines.
Please don't chase hype. Stick to your plan, your research, your risk tolerance. Ignore the noise as much as possible.
One last practical thing.
Mhm.
Taxes. People forget about those.
Oh yeah, very important. In the US at least, stock gains are taxed. Short-term gains, held less than a year, are taxed at your regular income rate. Long-term gains, held over a year, get lower rates.
Yeah, in crypto.
Generally taxed similarly to stocks regarding capital gains. But the tricky part is that almost every crypto transaction can trigger a taxable event. Buying something with crypto, trading one crypto for another. You need to keep good records. It can get complicated quickly.
Definitely something to research or get advice on.
For sure.
Okay, this brings us to a really important final warning, I think. We've talked about massive gains, Tesla's surge in 2020, Bitcoin's 2021 rally. It's easy to feel FOMO.
Fear of missing out. It's powerful. It's so powerful. But please, if you're listening, don't let FOMO drive your investment decisions. Chasing what already went up is often a recipe for buying at the top.
Exactly. Focus on your goals, your timeline, your comfort level with risk, not what everyone else is doing or what made someone else rich last year.
Right. So let's wrap this up. We've covered a lot of ground. Crypto versus stocks. It's clear there's no single winner.
Not at all.
Stocks offer that stability, the long history, the diversification. They're kind of the bedrock for most people's long-term plans.
It's a reliable foundation, generally speaking.
While crypto offers, that explosive potential, the cutting-edge tech, but it comes with serious volatility and risk. It's a high-stakes arena.
Undeniably.
So the best choice, it really truly comes down to you, your money, your goals, and frankly, how much uncertainty you can handle along the way.
That's the core message. And remember, a well-thought-out portfolio might even include a bit of both, balancing growth and stability. But the absolutely critical first step, do your homework. Understand what you're putting your money into.
Definitely. So we've gone deep into the numbers, the risks, the potential rewards. As you think about all this for yourself, what really stands out to you? And maybe more broadly, how does exploring these different approaches to investing shift how you think about risk, about innovation, and about planning your own financial future in this constantly changing world? Something to mull over.